Good afternoon, everyone. This is John DiMartino. I am a coach and an agent in production with a team over in Coral Springs, Keller Williams Realty in Coral Springs. I want to begin by, first of all, thanking you for showing up for the last 4 videos. And this is the 5th video, or section 5, of the 2020 Business Planning Clinic. And this is all about the budget model. The budget model is the 3rd model to be included in the business plan, and it's going to reflect the 30-30-40 cash flow that we discussed in video number 3 from the economic model. Now, the budget model is going to reflect the money that you make, the money that you spend, and the amount that's effectively the amount that's left over. Now, it's going to define your profitability and help you to maintain your expenses, minimize your expenses, and maximize your net income. Okay, so you can follow along in the participant guide, and I'll be periodically going back and forth through the participant guide, bringing it up on the screen as well. And this is going to begin on page 5-1, 5-1, which is all about the budget model. So let's turn to that page in our student book. So let's talk about our financial statements. So when we talk about our financial statements, remember we said several times already that we're no longer going to treat this as a job, and we're going to treat this as a business. Okay, and businesses have financial statements. All right, and the financial statements that we're going to be discussing specifically is the budget and the profit and loss statement. They're two different documents. They have two different purposes. Okay, the budget itself is useful when you're doing your goal setting, you're planning for the following year. You're going to create that budget annually, so you'll be creating that before the actual year begins, for budgeting for the following year. And then you're going to do it again next year, and then the following year, and so forth. All right. And the budget actually projects expected returns and expected cash flow. Now, the profit and loss statement, however, that's going to be a management tool. That's going to be a snapshot of where your business actually is. This shows your actual spend versus your projections. This is something I want you to get into the habit of. It says review bi-weekly. A business owner always knows their numbers, and they're always tracking their numbers, and they know where they stand compared to their budget. And if their expenses are too high, they need to either adjust income or reduce expenses. But they have to stay in line with what they initially budgeted, initially planned for. And that goes for expenses and for income. So the reason why they're saying here to review bi-weekly is if you put in your calendar that you're going to review your financial statement on the 15th of every month. If you're behind, you now have 2 more weeks left in the month where you can make those adjustments. If you just wait till the end of the month, you may just see what you already did without having the opportunity to actually make those adjustments. The key to this is make adjustments, adjust to win. Because that's, at the end of the day, that's what we want to do, is adjust to win. Now, these 2 essential documents, we talked about the budget and the P&L itself, and together they're a powerful financial decision-making and a goal-setting duo. They do not live in a vacuum independent of each other. They are 2 different documents that must work together so you can achieve your financial goals. The budget model itself, like I said, it's going to keep you from spending money on shiny objects or from losing track of your expenses. Everything invested should be looked at in a way that's informative. Now, we're also going to talk about holding your dollars accountable and holding your money accountable, and everything should bring you some kind of return. All right, the money spent, the expenses that you spend, that's going to be the cost of doing business. And for every dollar invested, you should receive some multiple of that dollar back. And what does that mean? We may go online and attend a webinar or decide we're going to get a new service or a new lead generation technique that we're going to be using. And if that has a expense with it, associated with it, All we're saying is, when we're saying hold your money accountable, all we're saying is make sure that that lead generation expense or that lead generation activity or whatever expense that you're having is giving you some form of return on that investment. If you're paying, and you're not getting anything back from it, mid-year, mid-quarter, even mid-month, if you're not getting the return back that you're expected, we need to restrain our expenses. We need to cut our expenses. Maybe we need to make that adjustment halfway through the year, halfway through the financial period. All right, so let's talk about that mindset. All right, so let's talk about that mindset regarding accounting. All right, no, I don't want to say nobody likes accounting, and a lot of people don't. Okay, a lot of people don't like accounting, and they feel because I'm not a numbers person, or I just don't like dealing with that. If that's you, you may want to consider hiring a bookkeeper, an accountant, or at least have a CPA that's going to help you with this. Okay. Now, if you have a CPA and your CPA just prepares your taxes once once a year, and you're only meeting with them and sharing your financial statements with them once a year, that's not, you're really shorting yourself. You're doing yourself a disservice. Have a CPA or have an accountant that's you're speaking with at a minimum quarterly. All right. But I really want to see monthly, if not, and I want you to review your documents bi-weekly. Even if you do have help from somebody else, you'll need to hold them accountable to the models for accounting purposes. Now, they can create your monthly P&L and they can discuss the differences to your budget, but it's up to you in order to hold those numbers accountable. And that's what I mean when you say practice accountability and not accounting. So some of the benefits of the budget model, it's the ability to assess whether you're running your business efficiently or not. Again, your numbers is proof of the health of your business. It can help you to evaluate your investments against your budget to see if you're on track for growth. It can provide benchmarks for what's possible for your business. It can give you a framework for categorizing and examining expenses. The budget model provides a common language for agents to speak to each other about their business and about the health of their business. And to be quite frank, it really will reveal whether you're meeting your goals from the economic model or not. So it's super important to, one, have a plan. We've spoken about the importance of having a plan, but have a plan for your finances and have a plan for your budget, and then hold those numbers accountable, hold yourself accountable, hold your person that's your bookkeeper, your accountant, or whoever's handling your money, hold them accountable to that as well. I'll talk about a couple of the budget terms that we'll be discussing. I know we briefly spoke about this in the economic model, but the cost of sales, gross profit, operating expenses, and net income. We're going to be discussing these terms several times during this model, but we've also throughout some of the other models as well. So just as a recap, the cost of sales is a payment made after the transaction is complete to either a listing agent or a buyer specialist. Okay. Now this can also include your commissions paid to the broker. This is your company dollar, your royalties to KW. This is your referral fees. Later on, when we cover the 7 levels of the organization model, you'll see that buyer's agents will show up in level 4 and the first listing agent shows up in level 5. And if your business hasn't grown to that level yet, if you're still an individual agent, a solo agent by yourself, that's great. Your cost of sales will still be relatively low. Gross profit is your gross commission income minus your cost of sales. So you hear us discuss that as well. Your operating expenses, those are the expenses that must be paid whether or not a transaction is made. These are your fixed costs, such as your salaries. This is your monthly costs for lead generation, for marketing, some of the tools that you'll have, and all the expenses that you pay. But these expenses are going to happen regardless whether or not a transaction occurs at all. Now, your net income is the total take-home pay. That's what you're going to take home and put into your bank account. And I want you to remember, this is pre-taxed. This is not including any taxes, any tax withholding or any taxes paid out or anything. Taxes paid are not operating expenses. All right, that's going to happen. That's up to you to pay after the fact. But the net income is the pre-tax income after the cost of sales and after operating expenses have already been removed. Okay. And like I said, this is the amount you may take as pay or additional pay, or you can use it to invest in your future, or it could roll it right back into your business. Okay, when we speak about taxes, again, this is something you're going to want to speak with an accountant or a CPA about. Your tax liability may be as high as 33% of your total net income. So speak with your accountant, find out how much taxes you should be paying, whether you should be paying quarterly payments, or at least you should be doing quarterly reporting. And speak with your accountant on that, and make sure you're putting money aside so that there's not a surprise when you're actually doing your taxes at the end of the year. So let's talk about those benchmarks. We spoke about this before. Remember, the MREA budget model is 30, 30, 40. That's the benchmark to strive for. All right. Now, these percentages are based on having a team, and not all agents or teams will have these exact percentage. And as your business is growing, your percentages will your percentages will be different. Now, the most important measurement is how much net profit you're receiving, and is it meeting the goal that you set in the economic model? Okay, so remember we talked about, of the total gross commission income, our goal is to have 40% of that become net income or a profit, while the other 60% is cost of sales and operating expenses. If you're running a business at 40% net income, if you're profiting 40% net income, your business is in a very good place. If you're not profiting or not netting at least 40% of your total gross commission income, then that's a sign that we need to get our expenses in line. And if we're profiting too much, that means you may be leaving money on the table by not spending money that could bring us additional gross commission income in. Your goal should be 40%. Ideally, that's where you want to strive for. Now, you may also find out that in some areas, the 30, 30, 40 may not work as well. Okay, it may be more expensive for less rewards, so the income may be less than 40%. It's okay to be outside of these values. Like I said, it just gives a framework for you to help to understand your business. Some solo agents that have very low expenses, they may be achieving 55 to 60% net income, and that's awesome. Again, that's going to be something you're going to want to speak with your coach about, to see there may be an area for you to spend additional money where you can that can help you to leverage time and money in order to get some more gross commission income. But again, these benchmarks are about thinking what's possible for your business. Also, remember this, in business, money is always an issue, whether you have too little of it or sometimes you may have more than expected. Now, your quest as a real estate sales business person or as a business owner is to increase your revenue, control your costs, and at the end of the day, increase your net income. Now, part of the battle is to become familiar and proficient with the economic model and the budget model. And much of the difference between having a business that earns $1 million and one that nets $1 million is often centered on two monetary disciplines: sticking to the budget model and controlling costs. Sticking to the budget model is harder than it looks, and controlling your expenses and controlling your costs is much easier than it sounds. And we're going to go through some of those, discuss some of those traps in a little bit of traps that you can fall in with your when it comes to controlling expenses. So let's talk about the cost of sales and operating expenses. Remember, we said that each of these are going to account for 30% of your total gross commission income. Now, I do want to remind you again one thing, that these percentages are benchmarks for agents that are earning $2.5 million in gross commission income. So they're going to be different for a lot of the agents at different levels of production. And remember, all the formulas that we're giving in this class, in this models, and in the Millionaire Real Estate Agent book is for agents that are going to net $1 million. So remember, we discussed earlier, if you wanted to net $1 million, you have to earn $2.5 million in gross commission income. 30% of that would be $750,000. That's going to be the cost of sales. And the another 30% is going to be for your operating expenses. And this shows what those percentage breakdowns would look like. Okay, so for example, the cost of sales, so it shows that only 5% of the gross commission income is just bonus pay to a listing specialist, whereas 25% of the gross commission income is pay for your buyer specialist. Your listing specialist may be getting a salary as well, but that's going to be on the salary is going to be on the operating expense side of for compensation. Operating expenses, remember, that's going to consist of the money paid out to generate leads and to operate your business. Now, the biggest difference between agents who are netting $1 million and those who are not is those who are netting are able to keep their operating expenses at that 30%. Remember, at the very bottom, it's going to show that 30% right over here. That's the $750,000. But the best ones that are going to control their expenses are controlling it to about 30%. According to the Millionaire Real Estate Agent, we have our operating expenses divided into 9 accounting categories. All right, or we can refer to them as buckets if you want. Compensation, lead generation, occupancy, education and training, supplies and office expenses, communication and technology, automobile expenses, equipment and furnishings, and insurance. And those are going to make up, all of your most of your operating expenses. Now, as you can see, just by looking at the percentages above, of the 9 categories, the first 2 are going to account for the lion's share of your total operating expenses. Compensation and lead generation are the big 2 noted by the red outline in the first 2 rows of your book. And if you hold these 2 items accountable for the budget, accountable to results, your budget will be a very, very healthy one. So when you're looking at these, what I want you to ask yourself is, when you're looking at these percentages, do these numbers surprise you? Do these numbers sound like they are out of line with what your existing expenses look like? Now, granted, some of your businesses are going to be a little bit different. Some may have lower auto expenses while they have higher occupancy expenses. And that's not a problem. Remember, again, like we said, these are just benchmarks. But the biggest point is just making sure that your expenses are controlled and kept to within 30% of your total gross commission income. Now, when we look at different benchmarks versus different price points or levels of production, this is going to show what your average agents are looking at. Remember, if you go over to the far right, we're seeing what an agent that's netting $1 million looks like at 2.5 in GCI versus the agent that is only earning $1 million in $1 million GCI. And these are just the best practices. And you'll see that these numbers and these percentages have changed, that they're going to change a little bit. However, something that you'll see for every one of these different GCI categories, the expenses is all going to be around that 30%. So the first 6 columns, these first columns right here, all right, these are averages. This is the average of how many agents that provided data for the research of the Millionaire Real Estate Agent. And the best practices shown are the GCIs for the 1 million and 2.5 million. And remember, those, like we said before, those come from the top agents who are consistently following the MREA models. Now, this chart is going to represent a growth path for you. The goal is to always get to that next level of net income. And as your business grows from one level of revenue or one level of GCI to the next, you're going to experience varying costs and percentages for the various expense details within your budget. So example, if you are a newer agent and you're just getting into production, or you are in your first or second year and you haven't made $100,000 yet in gross commission income, that's fine. These are the numbers that you're going to strive for. $150,000 total gross commission income. Your cost of sales is going to be relatively low because there's not a lot of, you don't have bonuses and salaries that you're paying out. Your gross profit, you see, is going to be much higher than that 70% that the MREA agents are doing. Okay, your expenses should be about 38%, and your net income is going to be about 49%. If you are hitting around 150, 200,000, set your goals for the next highest level here. So if you are hitting $150,000 in gross commission income, set these goals for the 340,000. If you're there, set the goals for 640,000. Every year, ideally, every year we're going to increase our business, and every year we're going to adjust our percentages until we get up to here, until we get up to netting $1 million. Again, these are just general examples of what budgets at various production levels may look like. At the end of the day, keep your focus on your net income or your profit margin. Now, when you're looking at some of these other percentages at each of these income levels, notice how different they are from the 30, 30, 40. Notice how net income decreases as GCI increases until you get to that 1 million or 2.5 million mark. Yet again, even while these are benchmarks and these are examples, the same principles hold true whether you're making $150,000 a year, whether you're making $2.5 million a year in GCI. So what I want you to do is, in your book, I want for you to circle the column that is closest to the GCI that you expect to make over the next 12 months. And whatever column you choose, the goal is to get to the next stage to achieve greater revenue and greater profit in the future. So let's take a look at operating expenses. This is going to be the operating expenses broken down by those 9 buckets that we discussed. For 150, all the way up to 2.5. And it's going to be breaking down, go back right there. And it's going to be breaking down what some of those, all throughout those categories. Remember, this is going to be your cost of sales, these first 2 up here. I'm sorry, of your operating expenses, this is going to be for compensation. This is going to be your salaries, your professional services, and so forth. And then lead generation. Remember, we said these are going to be your lion's share. Everything else is going to fill in the blanks. One thing you'll also notice on here is that there's no miscellaneous category. If you talk to any accountant, any bookkeeper, one of the things that they're going to hate when they're looking at budgets, looking at your P&L, is that line that says miscellaneous. They're going to say there's no such thing as miscellaneous income. This has to go into one of these buckets. Which bucket does it go into? So account for every dollar and hold every dollar accountable. One of the other things you'll see is that actual costs are going to change over time. And research indicates that no matter where you are in the continuum of costs, the percentages, for the most part, remain stable. Why is, when you're looking at some of these costs like this, why would you think that the automobile expenses for an agent producing $150,000 is so much higher, almost 6 times higher, than the automobile expenses for an agent that's making $2.5 million? And the reason is, and I'm sure there's a myriad of reasons, but one of the biggest reasons is the $2.5 million agent has a team, and they have agents that's running around doing their listing appointments. They're running around doing their buyer appointments. And that rainmaker or that team leader doesn't have to do as much, because they're also leveraging. I shouldn't say that they don't have to do as much. They're doing different work, right? But they're also leveraging time through their agents. Plus, it's also, as they make more money, obviously, we still want to keep that expense, that total expense, in line, but it's just going to be a lower amount in the big picture, in the big scheme of things here. If you're in the $150,000 or the $340,000 category, when you're doing your budget, these are the numbers these are the percentages, I should say, that you want to hold each of those buckets accountable to. So I want you to think about your expenses. How close are your operating expenses to the percentages shown in the table of the category, or the production level that you're closest to? When we're looking in terms of office supplies, Are you spending about $4,100? Or are you spending more than $4,100? When you think about your occupancy costs, is it about $4,200 or is it less? Or is it much more? How much are you spending in education? One of the things you see in here, education, whether it's attending Bold, whether it's attending specialty classes, whether it's a certification, whether it's hiring a coach, that number is probably one of, aside from lead generation and your compensation, that's the highest, that's the next highest operating expense. Because you're making an investment, you're making an investment into yourself. So let's actually scroll down. This is actually the profit and loss statement that we spoke about before. Now this is going to be a blank copy, and I'm going to provide you in the description box below. You're going to have a copy of the budget that you're going to use for yourself, and you're going to have a copy of a P&L that you can fill out as well. If you go to page 5.9. 5.9 of the, let me pull it up over here. 5.9 of the student workbook is going to discuss, again, what's the difference, or when is an expense a cost of sale? When is it an operating expense? When is it both compensation and a cost of sale? This question comes up a lot during business planning sessions. It comes up a lot anytime the budget model is being discussed. What's a cost of sale? Okay, and what is an operating expense? When does it become an operating expense? And this actually breaks it down pretty well over here. Cost of sales when they're paid on a commission, or if there's a bonus structure. Buyer's agents and showing agents are typically paid on bonus. It's an operating expense when there's a salary involved. Typically, salary positions are classified as employees. For example, your admin will be paid a salary as an employee. When you pay yourself a salary, that counts as an operating expense. But if you're working with someone and you're paying out referral fees, you're paying out bonuses and so forth, or you're paying out a commission split to someone else, that's going to count as a cost of sale. And there are times when it could be both compensation and a cost of sale. That's if they're paying a salary and they get a commission, like a ISA. If you have a ISA or if you have a listing agent, those are some of the ways that they get paid as well. But this question does come up a lot, and that's why I did want to go back to it. So let's go back to the profit and loss statement. Let me open this up right here. So let's go back to this profit and loss statement. So one of the things that you'll see is that we're going to provide you with is a chart of accounts. If you are familiar with the MREA chart of accounts, if you're familiar with accounting, you'll know what that means. And again, the MREA chart of accounts is those 9 buckets, and it breaks those 9 buckets down into further expenses as well. All right. Using the chart of accounts is how your profit and loss statement, what you can use in your profit and loss statement when you're entering your actual numbers. It's specifically designed for real estate. This chart of accounts is specifically designed for real estate professionals and will work at all levels. If you're hiring an accountant, or if you're a bookkeeper or a CPA, all right, make sure that they follow this real estate specific chart of accounts, or give them a copy of the MREA book so that they can understand the model as well. Like I said, there's going to be a link to it in the description below, and it is available for download. So one of the things you're going to do, you're going to use the chart of accounts to compare your budget to the actual models. I'm sorry, to the actual results. Give me 1 second. Okay, so you're going to use this to compare your budget to the actual models. Okay. And you're going to enter your budget amounts in one column and your actual results in another column. Now, there's a much more detailed version of the chart of accounts. And for each of those operating categories is a further breakdown as illustrated here with the lead generation and the conversion. Let's go back to the book for a second. I apologize. See how here the compensation is broken down into where that money is going, and the lead generation is broken down here into further subcategories, further subcategories as well. When you have, if you're using an accounting software such as QuickBooks or some other accounting software, even if you're using just a spreadsheet, you can still categorize everything into these buckets or into these categories and subcategories. But like I said, you want to do it based on these chart of accounts. And if you're working with a CPA or an accountant, when you prepare a P&L and you send it to them at the end of the year, they're going to help you track those deductions and exemptions and advise you on how to keep your taxable liability income lower. They'll reduce your net income, yet you pay less taxes. One of the things that we want to also really, really stress is you want to pay yourself first. Pay yourself a salary based on how much you would pay someone that you hire to do the work that you're doing. So definitely want to pay yourself a salary. That if you talk to an accountant, if you talk to anyone in the IRS, they're going to say, how much is a salary? They're going to say a reasonable salary for someone in your area doing that work. So what is a reasonable salary? That's kind of up to you. A reasonable salary may not be something where you're only getting, $100, $200 a month, maybe a couple $1,000 a month based off of the amount that you're actually producing. Speak to your accountant about that, because there are obviously tax ramifications with that. But pay yourself first. Pay yourself a salary. All right. Keep your lead generation and conversion expenses low when it comes to prospecting with social media. It could be really easy to just keep throwing money, thinking that's going to bring you, more leads. And if it is bringing you leads and those leads are actually converting, then great, keep doing it as long as it's staying in line with your budget. If it's not giving you the return, cut that expense and reinvest it somewhere else. Now, you're going to see some other things over here that's going to show your below the line income. Below the line items, those are income and expenses that are not directly related to your sales income. Everything else directly to your sales is what we call above the line. So things like your profit share, if you're receiving any vendor supplier income, that's going to be a below the line expense. If you have a large team and you're paying profit share, that's going to be a below the line expense. Any other additional income that you receive is going to be a below the line income. Okay. So again, if you do have profit share, you obviously still have to account for that, because that is still business income, but that's going to be a below the line income, and you're going to want to account for it on here. So continue going on. I want to talk about 4 budget focus areas. The first one is lead with revenue. And you'll see this is in your participation book on page 513. This is lead with revenue. Now, many real estate agents think that if they spend more money up front or build infrastructure or have a big sales organization, that the business is going to come to them. So there are a lot of agents that believe you have to spend money in order to make money. The beauty of the real estate sales business is the actual cost associated with getting a single buyer is actually quite low. With a proportionally small investment, you can generate revenue in your real estate sales business that will in turn fund the growth of your business. If you hold to the lead with revenue approach, it forces you to lead with lead generation and sales, not with expenses. A common theme anytime you're talking to your accountant, anytime you're talking to anyone familiar with the budget model and the MREA, the biggest thing they're going to say, and that's why this is number 1, is lead with revenue. Make money before you start to spend it. A lot of people will go ahead and say, well, I'm just going to spend this anyhow, and then I'll make money later. No, just lead with revenue. When you have the revenue, then you can start spending the money. Look at your expenses. Look at every one of your expenses and play a game called red light, green light. you should never be as concerned with how much money you're actually spending as you are with the results you're getting by spending it. This is what we spoke about, holding your money accountable. And if the money's not giving you a return, play red light and cut that expense or reduce that expense. And if you're seeing that you do have some expenses that are providing you a much higher yield on that investment, play green light on that. Spend some more money on that. When your costs creep up and have no corresponding increase in results, your business can be at risk. All right, now you can correct it by pulling out that stop sign and reevaluating that expense. So, example, if you're spending $300-400 a month on a bus bench ad, yet you spend $15 a month on a Facebook ad, one, you should always know where your expenses are coming from, your source of business is coming from. And if you start finding out that the majority, the lion's share of your leads are coming from the Facebook ads and not from that bus bench, maybe you decide, I'm not going to do this bus bench anymore because it's not bringing me the lead or the return that I'm expecting. A common misconception we'll hear in real estate is, if I only had one deal, it's going to pay it off for the entire year. And yes, well, that may be true. It's not a good mentality to have, because that's not the only budget, not the only expense that you're planning for. If that was your only expense, yeah, then that makes sense, but it's not. So try not to think about that. In terms of insulating your company against unexpected income shifts, you're going to want to concentrate on keeping your fixed costs as low as possible. In a shifting market, if you read the book Shift, in the shifting market, one of the very first things to do is cut all of your fixed expenses to as low as possible. Renegotiate that as low as possible. Now, during the pandemic, that was what most of us, many of us in Keller Williams did. We went back, looked at all of our expenses, and renegotiated or cut some things that were unnecessary, because that's going to directly affect how profitable we are going to be, especially during a tightened market. If you have higher fixed costs and face a shortfall in revenue or a shifting market, you might be tempted to cut back on variable and unfixed expenses like lead generation. However, if you cut down money that lead generation, that's the money that drives your business. It could actually be a pretty wicked catch-22 situation. Because of falling revenue, you cut back on investing in the very activities that are likely to increase your revenue. So cut your fixed expenses. Stick to the budget is the third, one of the third focus areas and third principles. Once you set up your budget with your economic model and your lead gen model in mind, it's important to check in with the budget regularly. Like we said, you want to look at it at least at a minimum monthly, bi-weekly if possible. That's the best practice. Keep your eye on that profit margin and plan for the next steps. That's what's ahead of you. Then get into rhythm. Prepare your budget for the upcoming year. Prepare that in September, October, November, with the previous 9 months of date to project from. Examine your P&L monthly. Keep your budget in sight and address your expenses as often as possible. Look for variances and analyze, if you're off, why. Because leading with revenue, playing red light, green light, sticking to your budget require you to stay in touch with your spending, and stay in touch with your spending often. Now, this is where we're talking about those budget model traps. It's easy to fall into some of the traps of the budget model. Not taking the time to understand how the models work and how it connects with the other models. Being too lenient with your money because you have the promise of big returns. Hiring too many people too quickly. You'll see so many people will turn around and say, I want to build a team. I'm going to hire a bunch of buyer's agents. And they realize that, one, there's not enough food to go around to feed everybody. Two, all of a sudden they're giving away the leads that they would normally be working. They give them to their buyer's agents because the buyer's agents are getting a little bit antsy and they're under threat of leaving because they're not getting the return that they wanted. Follow the model, and we'll talk about that in the organizational model differently. But hiring too many people too quickly is one of the biggest budget one of the biggest budget traps, and it's going to directly affect your profitability. If you're chasing GCI instead of your return on investment, all right, or if you're running a strict 30-30-40 business and never wanting to go up or below, that's cutting off your nose to spite your face. Remember, these are benchmarks. These aren't laws. These are tried and true best practices. They're not laws. Another trap is not accounting for your own expenses or your own salary or your company dollar, your split, your cost of sales, or being uncomfortable with budgeting and numbers and holding yourself accountable to it. That's why if you're not a numbers person, that's fine. Find someone who is and have them do this. If you don't like using Quicken or QuickBooks or anything, use an Excel spreadsheet. That's fine. But have some kind of thing, some kind of way to track your expenses. You're going to want some other best practices. You're going to use the MREA chart of accounts of your P&L to track all your numbers, your financial numbers for your business. That's not a personal budget. That's not a household budget. That is a business, real estate business budget only. Another class you could take if you really want to learn more about this is the Agent Financials course that's on KW University to learn more about how to manage the income, manage your financing, your taxes, and so forth. Okay. Also, we think about command. Think about how command affects our budget. We're only paying $20 and $25 a month for command. This comes out of your monthly cost. There are agents that's running Facebook ads in command. It says generate leads under $2. I ran a Facebook ad last week and I was getting leads for about 80 cents each. Unheard of. And it's amazing. And that's just doing everything directly through command. Another question you can ask yourself is, what are you spending for your platform, for your subscriptions and technology? How much are you spending each month on a CRM if you're not using command? How much are you spending on other technology, other marketing tools, other things to help you track your business? If you're not using command and you're using all these other third party, what they refer to as bolt-on technology, I want you to find out what the monthly cost is. I want you to add everything up, and then I want you to multiply that by 12. And then I want you to look at Keller Williams command, and you'll find that most of those bolt-on technologies that you have can be eliminated because it's already an applet in there in KW command, and it's only $20 to $25 a month. So again, KW command is there to help you to leverage your business, but also to help you save money and make money. You can enhance KW command with some of those third-party programs. We have integrations with great partners, access through the marketplace. Command isn't all or nothing. You can use it on your own. However, remember, it's going to affect your budget. And command, it ties in with the foundational tools that you can build on with other technology. Okay, so now let's talk about the business model. Again, the business plan consists of 2 budget tools. We talked about your budget based on your net income that you desire to receive and your monthly P&L to track how well you're doing. So what I'd like for everyone to do is I want you to create your own budget over here. Okay, you can either use these percentages or you can use the percentages that's applied over here for you based on the production level that you're at. But I want you to get these percentages and I want you to put that number in here. And that's going to help you to find out how much money you're allocated, not how much money you have to spend, how much money total max is allocated that, in that particular category. And remember, again, if you don't have a listing or a buyer specialist helping you with the transactions, great. Your cost of sales will only be your company dollar and royalties that you pay to the market center. But we're going to begin with the GCI goal from the economic model that we did earlier. We're going to enter the values for the budget plan based on the GCI and how you run the business. But then I want you to also compare it to the MREA budget just to see where you stand, how it stands. And you'll see that there's unless you're earning $1 million or netting $1 million, you'll see that those percentages and those numbers are much different. Again, remember, those are just benchmarks. So your homework after this video is to put together your business plan. And then I want you to go ahead and add a put together your profit and loss statement as well. And you'll see the links to that below in the description box. And then I want you to break out your 411. And you're going to add into your 411. Let me open it over here. You're going to add into your 411 an annual goal. Your annual goal is you're going to update your budget every year. Each month, you're going to review the budget model and adjust your numbers as needed. And you're going to complete and review your P&L results. Remember, we're not employees. We are running a business. We're business owners. So we're going to move. Our last thing we're going to do is we're going to do a quick recap of everything that we've learned in this model. The budget model, some people say, I don't like numbers. I don't like this model. Some people probably even skip this video. And if you're looking at your business as your job as being a business owner rather than a real estate agent, you'll find that this is probably one of the most important of all the models in order to help you become as profitable as you can. So a brief recap of what we've covered so far. We talked about the budget. We talked about the P&L. We talked about the mindset around budgeting. Talked about some of those terms and benchmarks that we had, the difference between cost of sales and expenses. We explained what those operating expense categories will look like. We also discussed a chart of accounts and those 4 focus areas. Lead with revenue, red light, green light, stick to the budget, check your P&L regularly, avoid certain budget traps. The last thing I would want everyone to do is I want you to go back and look at your notes. Look in the workbook. Hopefully you're taking some notes in the workbook. I want you to go back and ask yourself, what are some of the ahas that I had? What did I learn? What are the things that I'm going to implement right now? I'd like for you to discuss some of those ahas with your coach, with your accountability partner, with a peer, whoever is going to hold you accountable to your business. And then the last thing I want you to do is join us for the next video, which is going to be Mike Trelongo is going to go over the organizational model and how that's going to relate into your business. Just one last reminder, your homework, put together a P&L, put together a budget for what it's going to look like next year. And if you don't know your numbers from this previous year, that should be an aha moment for you as well. Professionals know their numbers. Thank you very much, everyone. My name is John DiMartino. I've enjoyed helping you with this class. I'm looking forward to